In today's video, I want to show you how to compare and contrast different days' volatility. Now we're going to use our morning volatility note to do that, and this is today's note, August 31st. After we review today's note, I'll show you yesterday's morning volatility note as well for August 30th, and you can very easily spot the difference. Now starting first with understanding today's volatility landscape, here's where our 10 major futures markets landed. All 4 of our index markets were on their scalper volatility box models, and if we plot where that is on our line graph, that's telling us that the 4 index markets were on the far left-hand side, their most aggressive volatility box models. If I review the other markets as well, the 30-year note was on its aggressive models with the scalper still being respected. Same thing with crude and natural gas. Copper had broken outside of the scalper. And gold and silver were also on the scalper models. So very little volatility for basically just seeing the amount of times that we notice scalper on this morning volatility note. Now let me contrast this with yesterday's morning volatility note, August 30th, and you can very easily spot the difference. Now this was yesterday's note that we sent to all of our futures members, and right off the bat, you should notice that there's way more text here. It's much longer. That's because we have active volatility tests where we're still monitoring certain levels. So we already know that, hey, we have breaches, and we can also see that our index markets are on the aggressive volatility box models here, all 4 of our index markets. If we plot this on the same line graph, this is where the index markets were yesterday, on the aggressive volatility box model notch. So today, the volatility is on the scalper models. Yesterday, the volatility was much higher on the aggressive models. Now, the interesting thing is, today, by the end of the day, we had all 4 of the index markets end on their aggressive volatility box models. So the volatility did increase as the day progressed. Now, if we start by reviewing the S&P 500 first, I have the scalper volatility box models loaded on, and this is how the morning started off. Price action was just chopping in between of our volatility box lines. Then came the 9 to 10 a.m. Pacific hour, where we saw that selling accelerate. Now, as that selling accelerated, we had a breach of our scalper volatility box models. So that's step 1. Step 2 is we're looking for the edge signal. Now, in the case of the S&P, the edge signal did not come until price had already broken outside of our clouds. So that's our very clear, easy cut sign that, hey, the scalper models are not being respected. We need to switch to the aggressive models. Now, the aggressive models are doing a much better job of containing price action here. You can see that with price breaching our sign entry line. We get the edge signal confirmation, so this is step 2 of our setup, and we're still respecting our clouds. We have not broken outside of the aggressive clouds. And we get an opportunity to enter at the sign entry line in the very next candle. The risk on this particular trade in the S&P 500 was 4.25 points. We were looking for that same 4.25 points for our first target, which we hit in this move up. For our remaining contracts, the stop got moved from outside of the clouds to break even. And for our second target, we're targeting the other side's target line, which if I zoom out, that should be a little bit easier to see, which in the case of the S&P was close to 13.25 points, which we hit in this move up here. So the S&P gave us from our entry right here, our T1, then the stop moved to break even, and then T2 is the other side's target lines, which when we do hit it is a really nice home run sort of trade. Now that was the only breach for the remaining of the day inside of the S&P 500. Now it was not just the S&P that gave us this entry, but it was also the Dow. If I switch over to a chart of the Dow, same idea here. Price action breaches our volatility box sign entry lines. That's step 1. We have the edge signal confirmation. That's step 2. We get an opportunity to enter at the sign entry line, and our stop is outside of the clouds. Now inside of the Dow, we did not hit T2, unlike the S&P 500, but we did hit our first target. First target we were looking for was about 33 points, and we made a max move of 70, but fell short of our second target, which was closer to that 90-point mark. So inside of the Dow, we hit just the first target. The S&P, we hit T1 and T2. Now the Nasdaq did not give us an entry, unlike the S&P and the Dow. The Nasdaq, we simply hit our sign entry lines, and we bounced away from there really not giving us a chance to enter at the sign entry line. So no trade for me inside of the Nasdaq. Finally, if I show you the Russell, same as the S&P and the Dow, had a similar pattern where price breached our sign entry line. That's step 1. We had the edge signal. That's step 2. And we had an opportunity to enter at the sign entry line. Inside of the Russell, the risk that we gave this trade was about 2.5 points. We were looking for that same 2.5 for our first target, went to a max of 6.3, but still fell short of the second target, which was closer to 7.9 points. So that's how price activity shaped up today. But the interesting thing that I thought was worthy of calling out was the difference in the morning volatility note, quite honestly. Just the sheer amount of fewer words inside of the note should give you an idea of how the volatility was much lower today to start off the morning compared to yesterday. As the day progressed, we saw volatility caught up. We ended on the aggressive volatility box models inside of all 4 of our index markets. Alright, I hope you found this video helpful. For all futures volatility box members, I'll leave a link to a video which breaks down the volatility note in more detail. Now, one last reminder, for all volatility box members, both futures and stock, we released our latest members only tutorial this week in which we build our dollar cost average calculator. It's useful to study what is the DCA effectiveness in any market you're looking at across however far back you'd like inside of Thinkorswim. I'll show you an example of that inside of the S&P in a future video, but for now, be sure to watch the tutorial, download the DCA calculator, and play around with it yourself. I think you'll find that it's very intuitive and it's a fun tutorial that I think you'll enjoy. Alright, take care everyone, good luck trading, and I'll see you in our next update.